Good afternoon, everybody. Welcome back to LPEA 10-year, 10-minute series. A very special guest today. Again, quite a less well-known strategy that is actually very successful. And we're lucky to host today the co-founder for this, Augustin Duhamel of 17 Capital. Hi, Augustin.
Good afternoon, Rajaa. Thank you for having me. It's a pleasure.
It's great that you're joining us from London. We're all the more happy as you're one of our newest members at LPEA, because you're not yet Luxembourg based, but we're working on it. And we invited you not because of that, actually, we invited you because you've been incredibly successful. You're one of the success stories of the PE world and seen at least in Europe, because your firm 17 Capital now manages over 4 billion, if I'm correct. And you're one of the two co-founders with Pierre-Antoine de Sélancy, who I hope is listening to us, also from London. You employ 50 people as we stand, mostly from the EU and the UK. And you have this very specific angle in your strategy, which is that you're a bit of a hybrid between debt financing and preferred equity, providing liquidity solutions to LPs and GPs. So our audience is a mix of a sophistication degree in terms of understanding PE. And unless I should have added something, Augustin, I would love to go into the three questions over the next 10 minutes before we open to the audience. And please, attendees, do use the opportunity to ask questions to Augustin. I mean, he speaks very well and he knows very well what he's doing. And we need to use this opportunity. Augustin, anything you'd like to add to the intro?
No, that was very flattering and a bit embarrassing, but I'm more than happy to tell you more about what you do.
Well, and what I didn't even say is you're an investment banker and consultant by training and studied business, but you're one of the few who managed to set up his private equity firm, having not worked in a private equity firm that's not his before.
That's yeah, I guess that was probably the only option for me to get into private equity, because otherwise when you're 35 it's pretty difficult to start and convince people to hire you.
That's true. 35. Okay, so now I know your age. Thank you. So Augustin, my first question for you is what do you do exactly at 17 Capital and how do you do it? Why did you go from a first fund of about 80 million to now a fifth fund that's over 1.5 billion? It's crazy, with a crisis in the middle. But tell us about your strategy and your specificities.
Obviously, we don't see it as crazy. We see it as normal growth in a very attractive market. But what are we doing? How do we do it? And how did we grow our business? We offer a very specific strategy, which is to provide financing against portfolio of private equity assets. So if you look back in time in 2008, when we started 17 Capital 12 years ago, so slightly longer than 10 years, 12. If you wanted to get liquidity against the portfolio of private equity assets at the time, your options were pretty limited. You could sell on the secondary market, in which case you were cutting your relationships with your underlying managers. You could borrow with the bank when that was available, and that was very rare, and there was nothing in it.
And I guess very, very low loan to value, no? For
very low loan to value indeed, on a very diversified portfolios as well. Anything in between was not available, and that's what we decided to create 17 Capital for, really to fill a gap in the market for those people who wanted to liquefy a portion of their portfolios without necessarily selling them, without cutting their relationships, and without selling the upside associated to their portfolios. How do we do it? We do it through preferred equity financing, which has the benefit of being very flexible. Preferred equity is quasi-equity. It doesn't have a repayment date. People who take money from us would only repay us as and when the underlying portfolios generate liquidity. It doesn't have covenants, it doesn't have security, we can't seize the assets. So we become really is a co-investor into those portfolios alongside the initial owner of the portfolios. The next question is probably who takes our money? Historically, when we started, we worked more with limited partners. who, if you think of 2009, 2010, a number of limited partners were looking for liquidity. Liquidity was scarce, and they were not necessarily looking to sell their portfolios, but they were welcoming some form of liquidity. And then as the cycle turned, we found ourselves in a much more bullish environment where people were not so much in need for liquidity, but at the same time, they were open to find financing solutions to grow their asset base. And that's when we turned more to funds themselves. So we moved from limited partners to funds, and then we provided financing to funds to help them put more money into their portfolios.
So you're kind of an all-weather solution, really, because people would have thought first you're a bad weather protection, but not really. And now that the market professionalized, you constantly need to ensure liquidity solutions for your portfolio.
We started investing in a crisis, and we all remember that was a pretty deep crisis. Of course, a question we had when we raised our successive funds was, are you a product of the crisis? And we proved that we had a market that we developed over those last 10 years. And now we're in a crisis again, where things might accelerate a bit, but they're only accelerating a long-term trend that we have witnessed.
No, but you're already starting my second question, Augustin. Thank you, because you started in 2008. No, it's good. You started in 2008. Some would say it couldn't be worse. So has the crisis accelerated your success at the time? Because then I'm going to come to the current crisis and how you draw parallels between the two. But tell us what happened. 2008, you raised whatever, 80 million, and a few months later, boom.
2008, it's slowed down our start because raising a first-time fund for a first-time product, officially launching fundraising in September 2008 is not the best timing of the market. So it took us 2 years to raise a first fund of 88 million euros. Then, of course, the market shifted, and we managed to grow larger funds. And we are now raising our fund number 5 with a much larger target.
But tell us about your first deal in that moment after raising the 88 million in 2009.
As a matter of fact, I can speak about that first deal quite openly because it was with a listed private equity vehicle, and as such, it was public. It was called Altamira Amboise, which was
which, sorry?
Altamira Amboise, which was co-investing alongside Apax in France. So it was really the listed private equity vehicle investing with Apax in France. And that was our first deal. We provided them with what was then 30 million of financing at a time, and we provided them with that financing with no discount at net asset value at a time where secondary prices were heavily discounted and at a time when their own share price was more than 50% discounted. So there was a lot of value for them to be able to find that money, which was not showing a discount to their net asset value.
Wow, okay, fascinating. So fast forward to 2020, 4 billion under management, obviously some incredibly successful exits, which you're welcome to comment upon. But do you see what's going on now as a crisis or a challenge for you as an opportunity? And can you compare what's going now in the markets with what happened back then with your first deal?
I mean, it's obviously a challenge for everyone. And there are different types of challenges, but in our world, the biggest challenge is not to make mistakes in an environment where there's much more uncertainty on the resilience and value of the underlying assets. Having said that, it's also an opportunity. We are offering a financing product. This is an environment where people are looking for financing, and sometimes against very high quality portfolios, which need, in some cases, some support, and with very high quality managers who are using the diversification of their portfolios to use the resilient assets to support the less resilient assets in their portfolio. So
pardon.
Yeah.
The fact that the banks retreat even more now in the current environment helps you, or in the end, you don't really consider them one of your substitute solutions?
So it does help us to another extent, which is that not only are we offering flexible preferred equity financing, but we are now starting to provide what we call NAV-based credit, which is more like a loan against the same private equity assets at a lower price, but with security and a repayment date.
And a lower return?
At a lower return, of course, yes.
Okay.
But the idea is that we're able to offer the same investors, the same managers against the same portfolios, a wider range of financing from preferred equity, very flexible, to credit, less flexible, but at a higher, at a more attractive pricing. And those two products are offered where the banks are not willing to come. So that's exactly.
Well, we have quite a few questions for you, Augustin, if you're happy to stay with us, because
yes,
the 10 minutes are up. The first question comes from a viewer who asks, how does the current crisis impact your pricing for the deal flow that you're seeing? Does it deteriorate?
Short answer, we have seen as much deal flow in the first half of 2020 as in the whole of 2019. So deal flow is increasing. And we are seeing definitely an increase in pricing compared to what we were seeing end of 2019 or beginning of 2020. So there is clearly, I mean, every type of financing has become more expensive within a few days between early and in March. And we have seen that on our product as well.
Wow. Okay. Other question probably from a GP asking you whether you stick to classical private equity strategies or if you expand to real estate or special situation funds or debt funds. Underlying assets.
Our strategies of a lower risk, lower volatility investment in private equity, and that's what we are offering our investors. And as such, we're trying not to go into strategies that offer more volatility underneath, like special seats. Real estate could be a good candidate, but to be honest, we have a lot to do with our core focus today, which is buyout, US, Europe. And we're really focusing on that.
Okay. Another question. So you said earlier that you're raising Fund 5 with a target of, I think, 1.8 billion.
Yes, correct.
And you said as well that it was really hard to raise your first fund because your first product fund, but how is it going with Fund 5 generically, because we're not here to talk about marketing?
Of course, this is not a fundraising pitch, but it's generally going well. It's easier to raise a fund when you have a track record of investing and of making exits. I will not pretend that the COVID crisis has not impacted the fundraise. Some LPs have just dropped the pen. On the other hand, it's quite comforting to see that a number of LPs are still able to work remotely, and we are doing interim closes remotely as well. So the fundraising world has not stopped. It has slowed down. It has not stopped. And we're working towards our target as expected.
How about your due diligence process? How has it been impacted? Because I guess you need to meet the GPs or the LPs that you're financing, or?
On the deal flow side, I think we are facing exactly the same challenges as limited partners when they are looking at a new fund. We are investing in portfolios managed by GPs. So we need to get comfortable that we have the right level of information. We have shifted to virtual DDs. Most of the investments that we have done since the beginning of the crisis have been with GPs we had prior relationships with, so that helps. You have met with people before, and where we could get some references from our own limited partners. So I would say that it has worked well, but especially with those people we knew before the crisis.
So you mentioned EU, US, more or less half-half now in your portfolio in terms of assets. How about currency risk? How do you manage that is a question I'm getting as well.
That's an interesting question. We didn't manage it in our earlier funds. In our previous fund, in our Fund 4, we have mostly managed it through our capital call bridge facility, where if we make an investment in dollars, we call the facility in dollars. If we so that we hedge that way. Of course, there's a cost associated to that because the facility would be more expensive in dollars today. And going forward, we will use, first of all, we have two sleeves in our fund 5, one in dollars, one in euros, which we didn't have before. And we will use some hedging for each sleeve, depending on the currency.
Okay. Questions are pouring for you, Augustin, very popular today. I mean, you said earlier there is no maturity in your typical portfolio, but I'm still getting asked what is the average holding period, let's say maybe for the NAV credit.
So there's no maturity in preferred equity financing. Average hold period is anywhere between 3 and 5 years. There is a maturity for the credit credit product, which is in the range, the same range of 5 years.
Okay, and minimum size of your ticket for credit in particular, or for actually for both, for credit and flexible equity?
We are increasing our fund sizes, so mechanically we're increasing the size of the deals we're looking at, and the market is coming our way with larger opportunities as well. We would typically start looking at something around 50 million.
Mm-hmm. Okay. As you know, especially for co-investments, a lot of PE managers set up single asset vehicles. Yes. More and more, also to attract more credit loans. What kind of duration do you see for that kind of credit? Is it the same as for a portfolio of assets as it is for single assets?
It's not our market. We are looking for diversification, and we would not do single asset transactions. On the pref side, we can look at 3 to 4 assets. On credit, we need 8, typically 7, 8 companies. So we are more of a diversified strategy than a single asset strategy. And as such, I'm less familiar with that market, so I would not venture into answering that question. So
going from 88 to 1.8 billion, maybe it's in line with how the private equity market grew in general, but how does that impact the nature of your LP base? What kind of LPs do you see, and how does it impact your whatever other dimensions you think are relevant?
So LP base, it doesn't impact it much to the extent that we had institutional investors from the very beginning. And in our fund 1, we had a number of visible institutional investors who had the capacity to grow with us in size and who are still with us in our fund 5, which is very, very comforting. So generally speaking, our investor base is much more institutional, Europe and North America. We have some family offices as well, and some institutionalized family offices. So it has not impacted the nature of our LP base that much. What it has changed is the size of deals, of course, the size of counterparties we are able to speak to. There's a number of large counterparties on our market where you need to have a large checkbook to be able to open the door and speak to them. And of course, it has changed a lot from a team management perspective. We have a team of 50 people today. There's a lot of implications in terms of how you manage that. There's a lot of investment put in the team, in training, in recruitment of the team as well. So risk management as well. We have a large portfolio today, which we didn't have when we started. So, I mean, we're growing a business, and we're adding a lot of functions.
As you're a form of secondary player, I'm thinking like firms like Color Capital and the likes, you are almost a big data company. You have information about so many deals and assets and regions and sectors that you could also monetize this at some stage, but this is just extrapolating a little bit.
We have a lot of data, and as we grow, we have more and more. We are not monetizing that to the outside world, so to say. We don't like to call ourselves a secondary, because the secondary buy from sellers, and we finance the people who don't want to sell. So we like to.
It's a very important educational point that we should hammer home, because there's a lot of confusion going on there. You're right.
Yeah, well, it's not so much confusion, but it's a differentiation point. We work with people who want to keep their assets, and financing against those assets. And as such, our sourcing and our deal flow is not on the secondary market.
But I've seen GP-led secondaries where the GP remains involved as well, because he's taking out some of his LPs. So in that, you overlap a bit with them.
You're absolutely right. The GP led, the GP keeps the management of the assets, but the secondary buyers buy from LPs who are willing to sell.
That's true. That's true.
So that's where the difference lies. And we're an alternative. Financing is an alternative to equity.
That's a good summary.
And that's
An alternative to equity. Yeah.
a much bigger market.
Yeah. No, I think we should bring you here for a longer session about what you do exactly, Augustin. So speaking of here, I said that when we started, you're one of the most recent members of LPEA. Thank you for joining us. You don't have any presence in Luxembourg, but your vehicles are actually domiciled here. So what is it going to take for you to set up an office?
Ask the British government. We started in London because we thought that was a good base to start covering the UK. And we started with onshore UK, Scottish as a matter of fact, vehicles. And our first fund was purely UK onshore based. If you look at our fund 5, it's only Luxembourg based with a UK based manager. As long as we can manage our funds from with a team from the UK, we will keep on doing so. There's a lot of uncertainty around that, and I'm pretty sure that over time, whatever the outcome of the Brexit negotiations, over time we will need to bring in more substance to Luxembourg. I think that's the way history is going. How fast? It's difficult for me to, you probably know better than me.
No, but Luxembourg is not a place where you have to run too fast, but you have to run in the long run. So we'll welcome you as and when you keep coming. But I think as soon as we can do more physical meetings, it's worth having a masterclass with you because what you're doing is truly unique. You haven't had much competition actually rise up to the challenge of competing with you.
No, it's still very limited. It's still an uncrowded market, which is developing fast. So we're trying to.
Congratulations for that. Everybody's throwing themselves into PE, but you seem to have a high barrier to entry, I guess, because of the nature of the solution that you provide and the relative complexity to the underlying product. But thank you so much for this. Anything, if someone from the audience asks us to have access to you for specific questions or follow-up, can we extend your details?
More than happy. More than happy.
Edith, and again, well done on a fantastic journey, and we will keep following you and stay in touch with us, please.
Thank you very much, Rajaa, and I hope to be in Luxembourg in person, hopefully soon enough.
Of course. À bientôt. Thank you so much. Bye bye, everyone.